profit is not cash. Now, there is another important factor, funding. Suppose the startup losses 50 crores this year, but investors put another 100 crores into the company. The company can continue operating. Next year, the losses another 70 crores, and investors provide more funding. So, the startup survives. But what happens when investors stop putting money into it? Now, the business has to answer such a more important question. Can it generate enough cash by itself? The answer is no. The startup can run into the serious trouble. So, not every negative cash flow is necessarily bad. For example, suppose a company spends 200 crores on a few new factory, technology, infrastructure, equipment, or qualifying long-term rights. That's huge cash outflow in the beginning, but if that investment helps the company generate strong cash outflows for the next 10 years, the initial negative cash flow may actually be good investment. So we need to ask, is the company burning cash because of the business model is weak, or is the investment cash because is it investing cash today to earn capacity for tomorrow? That's very important difference. That is why when I analyze a startup, I don't look only at revenue. I look at complete picture: revenue, gross margin, unit economics, profitability, operating cash flow, cash burn, funding requirement, and finally, can the business eventually fund its own growth? So, next time you hear the startup grows 100% this year, don't immediately think, wow, that company is successful. Instead, ask these questions. How much does that growth cost? Is this new customer creating value or destroying the value? How much cash is the company burning? How long can its funding last? And most importantly, is the company growing towards profitability or simply growing towards its next funding round? Remember these four things. Remember these four things. Growth is not success. Profit is not revenue is not profit. Profit is not cash, and funding is not the same as sustainability. Startup becomes sustainable business when it economics can eventually support its growth. But now, the real interesting question is, if the company is making losses, burning too much cash, and taking so much risk, why are investors still putting their money into it? What exactly investors are looking at? What is their investment logic? And how can they decide whether the potential return is worth taking this kind of risk? What do investors see, what we don't? That is what I will explain in the next part. Thank you for the more. Update me for the more update.